Ratio analysis for Campbell Soup Company. For our ratio analysis, we looked at the following ratios. Gross margin ratio. Gross margin informs how efficiently a company can convert a dollar of revenue into a dollar of profit after accounting for all the expenses required to run the business. In 2018, the gross margin ratio for Campbell Soup was 32.42, whereas the average for the past 5 years has been 36.07, and hence we can see a downward trend on the gross margin ratio for Campbell Soup. Net profit margin. Net profit margin is equal to how much net income or profit is generated as a percent of revenue. In 2018, the net profit margin for Campbell Soup was 3.01, whereas the average net profit margin for the past 5 years has been 8.52. In 2017, the net profit margin for Campbell Soup was 11.24, which is almost 4 times if compared to the net profit margin of 2018. Return on equity or ROE. Return on equity is calculated by dividing net income by shareholders' equity. Return on equity is considered a measure of how effectively management is using a company's assets to create profits. In 2018, the ROE was 19, and the average for the past 5 years has been 48.7. In 2017, the ROE for Campbell Soup was 53.9, which is 3 times more than that of the ROE of 2018. Return on assets or ROA. Return on assets measures how efficient a company's management is in generating profits from their assets. In 2018, the ROA was 1.79, whereas the average for the past 5 years has been 8.92. Hence, we can see that the ROA in 2018 is almost 5 times less than the average. Current ratio. Current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. In 2018, the current ratio for Campbell Soup was 0.63, and the average for the past 5 years has been 0.72. Days in sales receivable. Days in sales receivable is a measure of the average number of days that it takes a company to collect payment after a sale has been made. In 2018, the days in sales receivable was almost 33, whereas the average for the past 5 years has been 28.84, and hence we can tell that it takes Campbell's more days in 2018 to collect the payment after the sale has been made than in the past 5 years. Debt to equity ratio. Debt to equity is a measure of the degree to which a company is financing its operations through debt versus equity. It reflects the ability of shareholder equity to cover all outstanding debts in the event of a business downturn. In 2018, the debt-to-equity ratio for Campbell Soup was 7.2, whereas the average for the past 5 years has been 2.72. In 2017, the debt-to-equity for Campbell Soup was 2.1, which is 3 times less than that of 2018. Hence, we can see that Campbell's Soup has been taking more debt in 2018 than it usually does, which can be a good or a bad sign, which I will explain more in the summary slide. Summary. From the above ratio analysis performed, we can see that the profitability of Campbell's Soup is on a significant downward trend. Its gross margin ratio and the net profit margin ratios have fallen when compared to the 5-year average, but their revenues have remained stable for the past 5 years, which means that their expenses have been increasing as it is not generating enough profits. Hence, Campbell's needs to cut down on its expenses or generate more revenues by increasing market share to increase its profits. There has also been a significant downward trend in the ROE and the ROA, and an increase in the days in sales receivable ratios, which is not a good sign for Campbell's Soup. At the same time, we can see a significant 3.5 times increase in the debt to equity ratio when compared to the previous years, which means that Campbell's Soup is taking more debt than usual. This can be good or bad. The good thing could be that it is taking on debt as it is confident on its future outlook and wants to expand. On the other side, it can be bad as they can be taking debt to stay in business and not as a positive outlook.